my secret recipe to successful trading.
Stop. Don't skip this. If technical analysis feels confusing, even after watching dozens of videos, the problem is not you, it's how it is taught. I've been trading successfully for over 8 years, and wish someone had explained charts to me this way when I started. In the next few minutes, I'll show you a simple professional workflow that will completely change how you read charts. Apply them in order. Don't skip. Replay when you need it. Step 1. Structure mapping. If trend is higher highs, higher lows, it's uptrend. Lower highs, lower lows, it's downtrend. Neither of the above two conditions, sideways. Plan for, only buy trades when price is in uptrend. Sell trades, if it is in downtrend. No trade, if it is in sideways. Step 2, draw strong demand and supply zones on daily, weekly, monthly and above time frames. Higher the time frame, stronger the zone. Step 3, also mark high value support and resistance zones on these time frames. Only use zones where price reacted 2 to 3 times. Step 4, a hammer, inside bar or engulfing candlestick, at a major demand or supply zone, is worth more than an indicator signal. Look for rejection wicks and strong closes. Step 5, volume confirms moves. Strong buying candlesticks with low volume? Often fake. A valid demand pressure usually has expanding volume. Step 6, indicators are tools, not signals. I use one moving average for bias, 20, 50 or 200 depending on time frame. Fewer indicators, clearer decisions. Step 7, precise entries and stops. Entry when price reacts from strong demand or supply zone, with price action confirmation. Alternatively, enter a trade when price reaches a support level and gives a candlestick pattern confirmation. Look for volume spike too. Stop loss is where the structure breaks. This will signal you that buying pressure is getting rejected, so no need to stay there. Now comes the most important part. Define risk per trade, 1 to 2% of capital, and size position accordingly. Without risk control, the rest is just noise. Recap. Market structure, demand or supply zone, support resistance, price action, volume, indicators, risk. I've condensed this into a one-page printable technical analysis checklist that I personally use. Comment checklist and I'll share it with you. Don't go away. Now, I will explain definition of each jargon used till now. This will be helpful to people who are completely new to the stock market. What is structure mapping? In simple words, structure mapping means understanding how price is moving before deciding what to do. Imagine price is not random lines on a screen, but footsteps on sand. Structure mapping is simply observing those footsteps to see. Is price walking up? Is it walking down? Or is it just wandering around? In the stock market, structure mapping is the process of marking important turning points on a chart. By doing this, we can see where price previously went up strongly, fell sharply, or changed direction. By connecting these, you can clearly see whether the market is in an uptrend, making higher highs and higher lows, a downtrend, lower highs and lower lows, or moving sideways. For a beginner, structure mapping answers one powerful question. What is the market trying to do right now? Once you know that, every other decision becomes easier. Next, I will tell you what demand and supply zones are. Demand and supply zones are areas on a chart where big decisions were made in the past. Think of the stock market like a busy marketplace. Demand zones are places where many buyers rushed in and said, "This price is cheap, buy now." Price usually stopped falling and moved up from here. Supply zones are places where many sellers showed up and said, "This price is expensive, sell now." Price usually stopped rising and moved down from here. These zones form because large traders and institutions cannot buy or sell everything at once. They leave footprints on the chart. And those footprints often matter again in the future. Demand and supply zones are not exact lines. They are areas, like a parking zone, not a single parking spot. Next stop, support and resistance. Support is where buyers often says this is low enough, while resistance is where sellers says this is high enough. Think of them as floors and ceilings that price keeps reacting to. A hammer candle shows buyers stepping in strongly after a fall, pushing price back up and signaling selling pressure may be weakening. An inside bar pattern shows indecision and compression, often leading to a strong move once price breaks out. An engulfing candle shows one side completely overpowering the other, hinting at a possible change in market direction. A move with high volume shows strong interest and conviction, while low volume means the move may lack strength. In simple terms, volume answers the question, is the market serious about this move? A moving average smooths out price movements to show the market's overall direction clearly. Think of it as a guideline that helps you stay aligned with the trend instead of fighting it. In the end, I will talk about most underrated concept of trading: risk per trade and position sizing. Most beginners focus on how much money they can make. Professional traders focus on risk per trade. Risk per trade is the small, fixed amount you're willing to lose if a trade goes wrong. It protects your capital, controls emotions, and keeps you in the game long term. Because in trading, survival comes before profits. It's like going to a restaurant. You don't take all the money in your wallet and bet it on one dish, right? In shark market, a position simply means how much of a stock you are holding. Not your opinion, your actual money in the trade. It's like ordering food. 1 plate is fine, 10 plates means full commitment. A bigger position can give bigger profits, but also a bigger stomachache if it goes wrong. Legendary traders were right only about 40 to 50% of the time. They didn't win because of accuracy. They survived because of risk management. If this helped you think like a trader, like the video, comment your doubt, and subscribe for real market education.